Good morning, everyone. Welcome to this update for global stocks and commodities for the 9th of February. Wow, what a week. When I did this last Sunday, I don't think there would have been a commentator on the planet that would have said by Thursday the US market would be setting new all-time highs. Just quite extraordinary, and it just goes to show that markets are capable of doing the unexpected. So very, very quickly back to normal again, and as I said, new all-time highs on Thursday, and that just seemed almost impossible to imagine last Sunday. So let's jump in and take a look. Last week, what I said was that really we should trade what is, and that therefore we should assume that the 50-day moving average will hold. Now, I know most people were expecting something much more significant to the downside to unfold. I really didn't have much of an opinion. I'm surprised that the market didn't go lower. But I've just learnt over the last decade that if you try and second guess the market, you come unstuck. And so as much as I possibly can, I try and stick with trading what is in front of me. And as of last weekend, the S&P had not breached the 50-day moving average, and that is still the case. And we've had an extraordinary rebound. So it's just simply the ebb and the flow of a major bull market, and a bull market that's underpinned by reasonable fundamentals. Now, there's a lot of people out there over the last decade that don't want this to be so, and so they trot out all sorts of facts or supposed facts and opinions about where the market's going to go, and things like the Case-Shiller index, and as a demonstration that it's wildly overvalued, and so on and so forth. But at the end of the day, we've had a fairly mild economic recovery that since 2008 that has been extended because it never really got ahead of itself. And in the US, it's been good enough. And of course, central banks have helped with liquidity, and that's the result that we've got. And I'm not prepared to look forward towards an end to this bull market, because there's just no telling when it might occur. Portfolio analyst last week, amongst many really good questions last week, I did touch on the use of stop losses and trailing stops, and also managing volatility, because it looked like we were going to be in for a pretty precarious week. But in the end, that didn't really happen. We got Monday was down in Australia, but then that was pretty much the end of it. So let's jump into it. The S&P ended up rising by 103 points, 3.2%. Inconceivable last weekend. We saw reasonably good manufacturing and jobs data, which is quite encouraging. Earnings season is progressing along okay, and tech stocks are really good. So earnings across the board are they're good enough, and tech stocks were great, and healthcare stocks were pretty good as well. So earnings season is certainly not disappointing. We're also seeing global manufacturing PMIs, purchasing managers indexes, are rising off the bottom. So that's promising. So it looks like at a big picture level, the slowing global growth story is perhaps turning the corner. But of course, that data does not show the impact of the coronavirus, and therefore the slowdown in China. So we may see an impact. In fact, I'll be surprised if we don't see an impact in coming quarters from what's happening in China at the moment. So that's an unknown, but the Chinese central bank is stimulating big time. It's something like $180 billion of stimulus has gone in direct stimulus, plus they're also easing conditions for the banks as well. So one of the dangers of projecting a situation like this shutdown due to the virus in China is that people only look at the direct impact of the shutdown of commerce and manufacturing, but they don't look at what the government response might be and what positive impact that might have. And I think that's why the markets have recovered so quickly. the S&P index has effectively gone around the world. It went down to the 50-day and it recovered again in 10 days. Is just shows that it's absolutely impossible to react to that. If you'd reacted to what happened on Friday night, the previous Friday night, early last week, and then tried to scramble back in again, you would have almost assuredly have sold at unnecessarily low prices, and you would have bought back in, if you bought back in at all, at unnecessarily high prices. So the answer is always just to stay put and give it a bit of time until we can see the substance a little bit more clearly. The US dollar surprisingly has reversed higher again. I haven't been predicting the US dollar lower because I try and stay away from that, but I've just been noting two impacts. One is that Trump has been pressuring the Fed to get the US dollar lower. And secondly, the currency futures market has been very much positioned for a lower US dollar. So despite all that, the US dollar has reversed back up higher anyway. The 10 years stabilised, that had plunged from 1.9 down to 1.5, and we got a bit of a move higher towards the end of last week. All right, let's take a look at the S&P. So this is where we stood, this big red bar here, last Friday, the 31st of January. We'd gone down, we tagged the 50-day moving average, and then just look at the bounce that came after it. We got a gap higher on Monday, Tuesday, Wednesday, and Thursday. So 4 days in a row, the market gapped higher and then continued on up from there. So an incredibly powerful rebound, and on Thursday we set new all-time highs. So if nothing, if by nothing else, I hope that everyone that watches this video is now convinced that you should trade what you see and not what the media or a bunch of analysts start to project and predict what might happen. There's just there's no other good basis for action, in my opinion. Trade what you see in front of you, and keep it as simple as you possibly can. And of course, we saw the Nasdaq also doing extremely well. So this is the triple Qs, which is the ETF covering the Nasdaq, and just look how powerful this is. This is just extraordinary, and this is really the tech stocks. The Microsoft and Google and Amazon just doing fantastically well, and their results are coming through as well. The Amazon report was excellent. If we look at the US dollar, so this is on a weekly chart. You can see clearly an uptrending channel. We did break out of it for a period of about 5 or 6 weeks, but a very powerful week back into that uptrending channel. So going with the mantra of staying with what is, then you'd have to say that the US dollar is still in uptrend. That is going to keep downward pressure on the gold price. Whether the gold price goes down or not is another matter, because there's other factors at play there, but it's certainly keeping downward pressure, and it will certainly be putting downward pressure on the Australian dollar. And the Australian dollar, for a number of reasons, not only our economy, but also commodity prices. You can see was only on the 31st of December that we were trading at 70.2 cents, and now we've dropped to 66.75. So quite a sharp decline in the Australian dollar. Let's look at the ASX 200. So we had a breakout from these former highs that go back to 2007. We pulled back to test the breakout and then managed to bounce. So here was the fairly strong decline on Monday, and then the rest of the week was higher following global markets up. Okay, so let's just check in on Australian stocks. So it's really the Australian dollar, I think, at the moment is being most impacted by the fears about commodity prices. But look, it does help our stock market, because to overseas investors that make up about 40% of our stock market, A lower Australian dollar, of course, makes it more attractive to be buying our stocks. So that is having that sort of impact. Our index ended up rising just 5 points on the week. Healthcare was the strongest, energy was the weakest. And the technical disruptors, they performed extremely well considering. And I think at worst, most of the stocks that I'm invested in and members are invested in were at absolute worst neutral, and some of them went up quite sharply. So it was a pretty good week for the technical disruptor stocks. Precious metals, gold gave back last week's gain. So we went up about $20 last week. We came down $20 this week, and we're still sitting around the 1570 mark. So the big picture trend remains upwards, but with the US dollar seemingly gaining some support, it's going to keep the lid on things. One of the things that's now becoming apparent is that there is an increased flow of money into ETFs which cover gold. So not ETFs on gold stocks, but this is on gold itself. And that's showing that there is an increased level of buying into gold ETFs. And of course, if people are buying the ETF, then the fund manager has to go out and buy gold. So there is an added buying from that source. There is added buying from central banks. So we've got downward pressures on gold, but we've also got upward pressures as well. Now for precious metal stocks, GDX and the large cap global gold stocks are still really doing nothing, as we'll see, but certain Australian gold stocks have been offering extraordinary rewards, and I speak from time to time about a stock that I believe has been the premier gold stock on the planet for a decade. That's Northern Star, and I still see nothing to change that. And the fact that Northern Star is now trading at $13.50 when they've just finished raising capital at $9 is an extraordinary testament to how good that business is. Okay, so let's look at the gold price. So there's the gold price on a weekly. You can see still in a very powerful and very steep uptrending channel on a weekly basis. Let's look on the daily. I've left all this structure in place over the last few weeks and will continue to do so until this resolves itself one way or the other. So I was looking for the likelihood of an ABC correction because of the large overhang in the futures market that really does need to wash out, but just seems though it's not going to do that. So I thought that we would get either a mild decline to maybe somewhere around here, or a bigger decline to somewhere around here before we would bounce. Neither of those things has happened, and the net is that we've just really gone sideways. Turning to GDX on a weekly chart, you can see we're really just stuck. We haven't moved for 7 months now. GDX has really just been going sideways in a range. So it's very much a stock picker's market for gold. Other commodities, copper inched up a cent, I think, and China switching back on whenever that occurs is the key. You know, China is pretty much in lockdown, shutdown at the moment, and that will have an impact. We haven't seen that data yet, but we don't know how bad it's going to be. So again, don't try and anticipate how bad it might be. Let's wait until we see the results. And the market at the moment is certainly betting that the impact is not going to be all that great. Crude oil was down again because of both demand into China and also anticipated future demand into China. And if we look at the impact of China, focus on the blue bars. So we're looking at aluminium, copper, zinc, iron ore, nickel, and oil. And the blue bars show you today China's share of global consumption. It's just extraordinary. So we've got virtually all of the major base metals and steel making materials although it doesn't include coal there, but certainly iron ore. China consumes between 40 and 55% of the total world amount. Lesser so with oil, but still important. So that just gives you an idea of the very significant impact of China on commodity prices. So that's a story yet to play out. But at the moment, let's not try and second guess it. And the market is assuming that the impact is not going to be all that great. There's the spot copper chart. Very slightly higher. Nickel hasn't moved. It's been more resilient because of different dynamics. So my final thoughts, when we get periods like this, and we're probably going to continue to get these sort of situations, don't be the weak hands that runs away and hides because of what might happen. And what would actually concern me, because I always seem to be, preaching a bit of a positive outlook on things. What would actually concern me over the next 6 to 12 months? I think the two things that will potentially end this bull market is a breakout in inflation, which causes the Fed to raise interest rates. I think that would then be all bets off. But people have been expecting this inflation breakout since about 2012 because of all the stimulus, and it hasn't happened. And it hasn't happened largely because of technology. So there's no reason to suspect that inflation is going to kick up now. The second thing would be a Democratic win in November in the US. That would be incredibly unfriendly to the stock market, and that would concern me greatly. So they're the two things. I think global growth seems to be turning around. The trade war seems to be heading in the right direction, and in particular, China couldn't afford now with the impact of their virus shutdown. China couldn't afford to backtrack on this phase one deal. At this stage, you'd have to say that Trump is the favourite to win the election, whether you like him or hate him. He's done a lot of very good things for American economy, and something else that's not really getting much airplay is that he's actually doing a lot of good things for minority groups in America as well. So they're the things that would concern me as we progress through the year. As for the coronavirus, the media reporting is sensational, but the facts don't actually support that it's anything other than a seasonal flu. Now, I'm sorry, but they just don't. And there's not too many media outlets that are reporting the facts. But, if you can get a hold of some factual comparisons with just, the normal everyday flu season that we face every year without giving it some, massive pandemic label, it's the facts just are not supportive of a major problem. Portfolio analysts still haven't decided what I'm going to do this week, but look, we seem to have a very, very good session every week, and of course the 10-bagger portfolio and other high conviction stocks that I review have been doing exceedingly well. So we'll continue to have a focus on those also. There's my contact details for anyone that is not a member, and for anyone that's not tried the 2-week trial on Portfolio Analyst, it is available, and I think you would get a lot out of it. That's it for this week.